I hate to say it, but at least we're not Canada. Life in the United States is challenging, and unfortunately, I think it's getting more challenging for many of us, but our neighbors to the north have it much worse. Let's jump in and I'll share with you why I feel this way. First off, unemployment is quite a bit higher in Canada than it is here in the US. The bureaucratic red tape in Canada is quite a bit worse than here in the US. And the housing crisis, the lack of affordability, is worse. So let's jump in and talk about each of these. The first one is by the Financial Post, an article that, as I record this, came out a few weeks ago. And the article is called Canada Stuck in a Recession If You Look Past Their Headline Numbers, say economists. The real measuring stick of a country's economy is real GDP per capita. And if we look at that, the article goes on to say Canada's in a recession and has been for quite some time, says economist Lars Osberg. Perhaps it's not a true recession according to the standard definition, which requires 2 consecutive months of negative gross domestic product growth. But dropping below 1% in the third quarter, the GDP growth has slowed dramatically. And the unemployment rate in Canada rose to 6.8%, up a full percentage point from the same time last year. You can see the unemployment number here. Canada had the same crisis that happened during COVID with their unemployment rate skyrocketing to almost 15%. It dropped back down as COVID got more and more under control, but it's been going up slightly every quarter, every month, and you can see here it's at 6.8%. Okay, so that's unemployment. We talked about GDP per capita. Now, it's one thing to be GDP per capita. One of the things that you and I are worried about is how are real wages going up over time. So yes, I agree with that article from the Financial Post that looking at GDP per capita is important, but it's also important we look at, okay, GDP is going up, but are we getting our fair share of it as workers, or is it just the companies keeping everything? So I think that article is good, but I think I'd like to see the actual wage growth. And as we know in the US, our wage growth has stagnated and most people are making less today after inflation than what they were in 2020. In fact, in the US, we capped out at about $78,000, the median household income. So if there are 2 people working in a household, that would be both of their incomes. We capped out on an inflation basis at about $78,000. Today, that number is about $74,000. So on an inflation adjusted basis, that's $4,000 less that most households have. And most households are not saving any money. So where is that $4,000 coming from? It's being tacked onto our debt. But let's go back and look at the housing market now, the second point that I mentioned. How does that compare in Canada? And this is an article by NerdWallet. It's called Canada's Harsh Housing Market. How did we get there? We being Canadians. And this shows what the home prices are versus household earnings. You can see in 1980, the median household income, that median house, the average house, cost about 3 times what a Canadian was making. And now 40 years later in 2020, you can see it's crept up from 3.2% in 1990 was 3.4 times the median household income, then 3.5. So it stayed in that 3 range, but look what happened in 2010. So in that decade from 2000 to 2010, in Canada, the price to income ratio went from 3.5 times the median household salary to almost 6, 5.9. And in the 10 years since 2010, it's increased to 6.7 times. So how does that compare here in the US? This is according to the Joint Center for Housing Studies of Harvard University. Same thing, the home price to income ratio. It's reaching a record high in the US, but you can see it's not 6.7 times here in the US. It's right at 5.5, somewhere between 5.5 and 6. So Canada, is going through its challenges. The United States is going through challenges. And we see it not just in the United States, but in other countries where the average worker is getting squeezed. Here in the US, the GDP per capita continues to go up. Same thing in Canada, but not at the same rate as here in the US. But even though the GDP has gone up, the output of workers has gone up, we have not kept up with that, but it's much worse in Canada. So what does this mean for all of us? I think the first thing is the importance of having a rainy day fund, an emergency fund. Over half of all Americans say that they could not afford to pay cash for a $1,000 unexpected expense, whether that's a broken arm, your car breaks down, something like that. We'd have to put that on our credit cards. And as we know, our credit cards, the cost on our credit card, for most of us is 20, 25%, 30%. So rule number one is start building up a rainy day fund, an emergency fund of at least 3 to 6 months. I like to have I think the older you are, the more of a rainy day fund we need, because when it really starts to pour for you and I is if, God forbid, one of us were to lose our jobs and we have to look for another job. That rainy day fund gives you time to not take the very next job that comes along, but to wait until the right job comes along. So that's what that emergency fund gives you. So that's rule number one. Rule number two is really looking at our spending and saying, what can we do to reduce our spending so we can save more? I know that's not a popular message. Nobody wants to hear that. None of us like to diet. None of us like to exercise. And none of us like to have to sacrifice today for a more secure future. But I think, the way I look at it is right now I'm 60. And 65-year-old Azul is going to be grateful for the decisions that 50-year-old Azul made, 55-year-old Azul. And it's the same thing for you. I want you to look back and be grateful for the decisions. So when it comes to saving, unfortunately, I do not think it's enough to save 10% like our parents did. In our parents' generation, they could count on 3 foundations for their retirement. The one is saving for our retirement like we are, but they also had Social Security, and Social Security was more dependable. As I record this, the Social Security Trust Fund is due to run out of resources in less than 10 years. That's not a lot of time. But even if the trust fund does go away, it doesn't mean that Social Security goes away, but it probably does mean that we're not going to get the same level of benefits that we do today unless a solution has come up. And then the third one that many of our parents could depend on, in 1970, 40% of all private sector workers had access to pensions. And now, unless you work for the government or you're grandfathered into a program, very few of us have access to a pension. So for all of those reasons, making good decisions is important for us. As I said in this video, it's tough here in the US, but I think it's tougher other places, Canada being just one example. If you enjoyed this video, YouTube says that you'll enjoy this video of mine next. Let me know if they're right, and thanks for watching this one. I'll see you next time.